Another midweek edition of the Market Review, where we bring you developments in the financial and capital markets as it relates to the economy. It's the 26th day of August 2020, and you're welcome to this session. If you're watching from Nigeria and across the world, let's get on to discuss the private equity space today on midweek. I will give you a lineup of what we'll be discussing. We got the Finance Act 2019 bill. This is one bill that has really brought up transformation in the Nigerian fiscal and economic space. What does it foretell for the private equity industry? That's what we'll be looking at today. And also we'll be discussing fundraising, investments, transaction, and tax incentives presentations, but giving you some insight into how the private equity will be able to navigate and be impacted by these various developments. So let's begin with the Finance Act 2019, which has made significant changes to the tax regime in Nigeria. Several policy experts have talked extensively around this act and what it foretells for the country. The act makes changes to legislation such as the Companies and Income Tax, which we also call CITA, the Petroleum Profit Tax Act, the PPTA, the Personal Income Tax, which you can also call PITA, and the Value Added Tax Act, that's the VATA, and Capital Gains Tax Act, CGTA, amongst others. From the analysis, the anticipation is that some of these reforms will be of interest, and which we know now, to the private equity and venture capital investors and fund managers interested in Nigeria. This is because the changes will have an impact on matters such as investment strategies, tax planning, and revenue forecast. Here are the relevant changes and potential implications for the private equity industry since the signing of the Finance Act 2019. First, look at taxation of digital and remote services. This has been described as a key reform introduced by the Finance Act relating to taxation of foreign companies that provide digital content and services or engage in digital transactions or technical management consultancy professional services to persons in Nigeria. Before the Finance Act was signed, the physical presence of the foreign company or its agent in Nigeria was a primary consideration whilst determining whether profits of the company were derived from Nigeria. However, pursuant to the CITA, that's the Company Income Tax Act, as amended by the Finance Act, a digital or virtual presence may now suffice. Thus, the profits of a foreign company shall also be deemed to be derived from Nigeria, and we're going to highlight this, the company transmits signals, messages, and data of any kind to Nigeria in respect of any activity, including electronic commerce, or what we call e-commerce, online payment platforms, and online advertisements, to the extent that the company has a significant economic presence in Nigeria and profit can be attributable to such activity. And the trade or business involves rendering technical, professional, management, and consultancy services outside Nigeria to a person resident in Nigeria to the extent that the company has a significant economic presence in Nigeria. In exercise of statutory powers, the Minister of Finance, who issued the Companies Income Tax Significant Economic Presence Order 2020, earlier this year, May 29, 2020, the SEP order, which became effective on 3rd of February 2020, stipulates that what will constitute a significant economic presence of a foreign company. Thus, where a foreign company that provides digital content and services is deemed to have a significant economic presence in Nigeria, its profits will be subject to companies' income tax of 30%. Where the foreign company provides technical management, professional or consultancy services, it will suffer 10% withholding tax when it receives payment for these services from a person resident in Nigeria or a fixed base or agent of a foreign company in Nigeria. So what are the planning points? Nigeria is currently a party to bilateral double tax agreements, and this covers 14 countries. Nigeria's power to tax the profits of a company resident in any foreign territory is covered by a DTA and is only exercisable in respect of profits attributable to a permanent establishment, essence, or a physical presence in Nigeria. As such, there may be an opportunity for multinational enterprises with access to benefits under Nigeria's jurisdiction to optimize their group structures with a view to mitigating the impact of the SCP provisions. In exploring that opportunity, it should be noted that the extent to which the DTAs should prevail over the SCP provisions is still uncertain. Also, the OECD's ongoing work on taxation of the digital economy could potentially extend the definition of a permanent establishment in the DTAs to include provisions similar to those of the Special Economic Presence Order. Now let's look at the removal of full withholding tax exemption for long-term foreign loans. Prior to the enactment of the Finance Act, interest paid from a Nigerian company to a foreign leader were fully exempted from withholding tax if the underlying loan had a repayment period inclusive of any moratorium of more than 7 years. Partial exemptions were available on a graduated basis for shorter tenor loans, and any withholding tax chargeable as a result was the only tax on such interest. The amendments introduced by the Finance Act have reduced the withholding tax exemptions on interest on such foreign loans to a maximum of 70%. The planning points here states that given the reduction in the tax exemptions in respect of interest on foreign loans, fund managers will need to recognize the drop in net interest income from companies which have been funded with long-term debt and its impact on things like PIK notes. They will also need to re-evaluate strategies for negotiating debt instruments such as convertible loan notes. Let's look at thin capitalization rules that are provided for by the Finance Act. Prior to the introduction of the thin capitalization rules by the Finance Act, Nigerian companies enjoyed unlimited deductibility of interest expense for income tax purposes. An interest not deducted could be carried forward indefinitely. Under the amended CETA, that's the Company Income Tax Act, a tax deduction in respect of interest paid on a loan received from or guaranteed by a foreign connected party must not exceed 30% of the taxpayer's EBITDA. However, it also appears that the 30% limit would apply to interest paid in respect of a loan received from an unrelated party but which is guaranteed by an unrelated party. Interest on debt provided by local lenders is, however, still deductible without limit. Interest not deducted due to the above restriction can still be carried forward, but only for a maximum of 5 years. The planning points here is that private equity fund managers should be mindful of the impact of thin capitalization rules on the after-tax profits and consequently on the distributable profits of their portfolio companies, where such companies are already funded using debt provided by a foreign-related party or guaranteed by either a foreign-related party or by an unrelated party. Consideration should be to optimizing the debt mix by substituting local debt for foreign debt where possible, whilst bearing in mind transfer pricing rules that may adjust interest rates to reflect arm's length conditions. Let's look at an interesting one, which is the tax holiday for agricultural companies. The provision in the Company Income Tax Act, as amended by the Finance Act 2019, relating to tax holidays for companies engaged in agricultural production may make potential investments in Nigerian agribusinesses a more attractive proposition for fund managers. Before now, such companies enjoyed income tax exemption under the Industrial Development Tax Relief Act for a period of up to 5 years. However, in terms of the amended CETA, companies engaged in agricultural production may now enjoy income tax exemption for up to 8 years, subject to the satisfactory performance of agricultural production. And then we go to the tax-free earnings for real estate investment companies. The amendments to CETA, pursuant to the Finance Act 2019, relating to the taxation of real estate investment companies is also relevant to investors in the real estate sector. The amended CETA provides that provides that dividend and rental income received by a real estate investment company will be exempt from tax, provided that 75% of the dividend or rental income is distributed within 12 months of the end of the financial year in which the dividend or rental income was earned. If the distribution does not take place within this period, the tax exemption will be lost and such earnings will be assessed to tax. Elimination of punitive taxation of tax-exempt income and retained earnings. This will be of huge interest to private equity companies. And before the recent amendment of the CETA, where a Nigerian company paid dividends that exceeded its profits, the tax payable by the company would be based on the dividends and not on the lower profit. This meant that a portfolio company would be liable to income tax if it distributed dividends from tax-exempt income, or to a further income tax if it distributed dividends from retained earnings which had previously suffered tax. It also created a disincentive to use local holding companies, as a distribution of the dividends received by a holding company to its shareholders would invariably trigger further tax liability. So SITA has now been amended so that no further company's income tax will apply to dividends which are, in this category, paid out of retained earnings that have suffered tax under the SITA, PPTA, or CGTA, paid out of tax-exempt income, paid out of franked investment income, or paid by a real estate investment company from its rental or dividend incomes. These amendments effectively eliminate the double taxation that occurs where such dividends are paid from retained earnings that have been taxed. They also ensure that tax incentives are not eroded when dividends that are paid out of tax-exempt income are distributed. What are the planning points from this? As a result of this reform, companies can distribute dividends from tax-exempt income without paying income tax, and distribute dividends from retained earnings without paying a further income tax. Conversely, the pressure to distribute all profits in a financial year in order to avoid double taxation is removed. Another key implication of the reforms is that where investors determine that it is beneficial to set up a holding structure in Nigeria, that can now be done on a tax-neutral basis and without concerns about the possible double taxation of the profits of subsidiaries and erosion of tax incentives. Now let's go to the aspect of the possible income tax and VAT exposure for foreign entities. Recent decisions of the Nigerian courts and the amendment of the Value-Added Tax Act's definition of exported service may have broader tax implications for fund managers who would ordinarily be considered not to be tax resident in Nigeria, particularly if they seek to raise funds from Nigerian investors. Prior to its amendment by the Finance Act, the VAT Act defined an exported service as a service performed by a Nigerian resident or a Nigerian company to a person outside Nigeria. As exported services were and still are exempt from VAT, one view widely held in practice was that a Nigerian entity marketing funds to Nigerian residents on behalf of a non-resident fund manager was not required to include VAT in an invoice for that service or to include such transaction in its VAT returns for the relevant period. However, in the Alan Gray Investment Management Nigeria Limited Appellant versus Federal Inland Revenue Service case, the Tax Appeal Tribunal, TAT, took that view that the South African investment manager was carrying on business in Nigeria because its Nigeria subsidiary marketed investment funds to Nigerian residents on its behalf. That finding was used to support a decision that services rendered by the local subsidiary were in fact rendered to a fixed base of the non-resident company and therefore could not be considered to be exported services. The decision in Gray now appears to have been codified by the Finance Act's redefinition of exported services as expressly excluding services provided to the fixed base or permanent establishment of a non-resident person. One implication of this development is that Nigerian companies or individuals that are engaged to market foreign funds to local investors on behalf of non-resident fund managers will now be required to issue VAT invoices in respect of such services. There is also a chance that the tax authorities and courts could begin to take the view following the TAT's reasoning in the Alan Gray decision that foreign private equity funds sourcing investors through local representative offices should be deemed to have a permanent establishment of fixed base in Nigeria and therefore be liable to pay income taxes in Nigeria. The planning point here is that it is necessary for fund residents outside Nigeria to assess their operations and existing relationships with local representatives or agents to determine whether the prevailing circumstances are such that their firms may be deemed to have establishment or fixed base in Nigeria and therefore liable to pay taxes such as VAT and company income tax. In the area of the VAT and company gains tax exemptions on business reorganization, we looked at the fact that prior to the Finance Act, the transfer of assets in the course of a business reorganization was constructed as a disposal for the purpose of the company gains tax. Such transfer of assets was also deemed as a supply of goods to the transferee and was therefore subject to VAT. This was so even if the transferee was a wholly owned subsidiary of the selling entity. The Finance Act has introduced amendments to correct that now, the Capital Gains Tax Act and the Value Added Tax Act. The effect of these amendments in the capital gains tax and value added tax will no longer be payable upon the sale or transfer of assets during a business reorganization if on these various conditions. The sale or transfer is to a Nigerian company for a purpose of better organization of that trade or business or the transfer of its management to Nigeria, and if the entities are related, that is, one company has control over the other, or both companies are controlled by some other person, or both companies are members of a reorganized group of companies for a minimum period of 365 days prior to the date of reorganization. However, if the transferee subsequently disposes of the assets within 365 days, which is a year, after the date of the transaction, the tax exemptions will be rescinded. What are the planning points taken from this context? Opting for an asset acquisition rather than a share acquisition will now be taxed, but in a neutral level. It would involve the following three-step process. The selling entity will incorporate a wholly owned subsidiary. The selling entity will transfer the assets to the wholly owned subsidiary after 365 days, and the selling entity will then sell the subsidiary to the acquirer, where a portfolio company, a private equity fund, is the seller. This three-step process will also be available. The incentives for small businesses are also there in the Finance Act as it concerns private equity investments. It provides that small businesses, that is with a turnover of 25 million naira or less, are exempted from the company income tax, whilst medium-sized companies, that is with a turnover greater than 25 million naira but less than 100 million naira, are to be taxed at a reduced rate of 20%. On the withholding tax on dividends from petroleum profits, before now dividends were paid out of profits that have been subjected to petroleum profits tax and did not suffer withholding tax. This meant that private equity entities with investments in the petroleum industry could receive dividends thereof free of withholding tax. However, such dividends will now suffer withholding tax of 10%, although shareholders that are residents in the country that has a DTA with Nigeria will enjoy a reduced rate of 7.5%. Very, very robust and comprehensive insight on how the Finance Act will impact private equity activities and investments in Nigeria. From the stable of the notable Udoma and Osage chambers, the issues of fundraising and the other aspects of private equity activities comes to the fore to look at how this industry is thriving amidst the challenging phase we are in. Fundraising activities continue amid the challenge backdrop of Nigeria's economic growth projection and now even fueled by the COVID-19 pandemic. The number of Nigeria-focused funds seeking capital continues to grow as general partners continue to see opportunities for investment in Nigeria. For example, Vero Capital Management, a major player in the private equity space, recently announced an interim close of its Vero Capital Growth Fund 3 LP with commitments of $200 million. In the area of investment, Nigeria remains an important investment destination in Africa as one of the most popular investment destinations in West Africa alongside the likes of Cote d'Ivoire, Senegal, Ghana, and Benin Republic. Available data from the National Bureau of Statistics indicates, however, that there's been a decline in the total value of foreign investments coming into Nigeria. In 2019, that figure was $934.34 million, while in 2018 it was $19 billion. The financial services, telecommunications, manufacturing, and agricultural sectors attracted most of the foreign direct investments in 2019. Coca-Cola's acquisition of Chi Limited and the merger of Access Bank and Diamond Bank were some of the significant deals in the market as at that period. Other significant deals that have occurred include the Vera Capital Management's investment in Daystar Power Group, Sahel Capital's investment in Lad Group Limited, and the Partech-led Series A funding of Kudi, a leading digital payments and collections company. If we take a look at transactions in the private equity space in Nigeria, the most common types of private equity transactions in Nigeria are the acquisition of shares through subscription of transfer from existing shareholders. Quasi-equity instruments and more recently, debt are also part of that space. Traditionally, structures used for transactions include equity acquisitions, usually by offshore registered special purpose vehicles of majority or significant minority interest in Nigeria, portfolio companies. However, current economic challenges and risk management concerns are contributing to the evolving trends towards adopting debt and convertible instruments and alternative capital structures. Investments are typically made in companies with a good track record of performance, potential for growth, and a good management team are all very important. Let's take a look at the exits that have occurred this period, particularly in the private equity space. Now, secondary sales to trade buyers, private equity firms, and other financial buyers remain the most common forms of exits. That's how people exit the space. And notable exits, if you capture 2019, include the Vera Capital Management exits from Roto Prints Limited, a leading vertically integrated supplier of flexible package products to top-tier consumer products across West Africa. The UTL Trust Management Services Limited, a Nigerian trust company based in Lagos. And of course, Helios Investment Partners exits from Elan Oil and Gas PLC, and the Africa Capital Alliance exits from Cornerstone Tower were also significant exits in private equity phase. Private equity funds in Nigeria usually obtain funding from institutional investors, such as pension funds, sovereign wealth funds, development financial institutions, insurance companies, financial institutions, and high net worth individuals. That's how they generate those funds, just for those that are curious to know. Now, look at the tax incentive schemes. The investment incentive includes the following when you look at the schemes that are available for improving the activities of PEs. The Pioneer Saddle Scheme grants companies operating in certain industries a non-renewable income tax holiday for a period of 3 years, which can be extended for additional 2 years. Interest earned by a foreign company on its deposits in domiciliary accounts in Nigeria is exempt from tax. Purchasers of local plant and equipment are entitled to an investment allowance of 10%. Capital gains tax, the CGT, is not levied on gains from the sales of shares, stocks, and treasury bills. Companies engaging in the use of Nigeria's natural gas resources are entitled to a tax-free holiday for an initial period of 3 years, or an additional investment allowance of 35%. Machinery and equipment purchased for the use of gas in downstream operations are exempt from value-added tax. Interest on securities issued by the federal government of Nigeria and on state, corporate, and supernatural bonds are exempt from tax until 1st January 2022. Interest payments on foreign loans that have a repayment period, including moratorium and grace period of 2 years and above, enjoy significant tax exemptions from 10% up to 70%. Consequently, private equity funds that provide debt capital can enjoy a reduction in their tax liability. Investors from countries that have a double taxation treaty with Nigeria enjoy a withholding tax reduction of up to 7.5%. Companies located in export processing zones are entitled to a 100% capital allowance in the year of assessment. In addition, a company that is 100% export-oriented but located outside an EPZ enjoys a 3-year tax holiday. Profits of companies whose supplies are exclusively inputs for the manufacture of products for export are exempt from tax. If plant and machinery are transferred to a new company, the tax written down value of the asset transferred must not exceed 25% of the total value of plant and machinery in the new company. Those are interesting insights from the private equity venture capital space. I'll continue to bring you more of this in our midweek editions, and including conversation and interviews around the industry. That will be all for the market review today. You can join us throughout the week for reports, analysis, and exclusive interviews on the Nigerian capital and financial market as it affects the economy. Also send your views and comments, or even questions to news@prochange.com. We would like to hear from you and how the program is and what you'd like to see more. Also log on to our website www.prochange.com to watch our videos, read our news reports and analysis. To all investors and the public this period, we would like you to be aware of online platforms that promise you 100 to 200% returns but are not registered or regulated by the Securities and Exchange Commission. Do not give in to their schemes and strategies because they are out to rip you off your hard-earned savings. That will be all for this edition. Once again, join us tomorrow 10 a.m. as we continue this conversation looking at the commodities market. Thank you for watching. Have a nice day and stay safe.